So in the last video we covered fixed annuities. Now we're going to move on to variable annuities. Now a variable annuity is just a little bit different. Where a fixed annuity, you're dealing with the insurance company's portfolio, typically bond-based portfolio, very conservative. Variable annuities allow you to get exposure to the stock market and get exposure to different types of investment markets. Now another thing that happens with annuities, and typically a lot of times variable annuities are used in IRAs. They're used in IRAs again because of the commission structure of the variable annuity, much higher than typical mutual funds. So a lot of times investment advisors will recommend this product because it pays them more, quite frankly. Now, again, like the fixed annuity, you get the gains that, if you have it in a non-qualified format, in other words, you're holding the annuity separate outside of an IRA, when you get the gains, you don't have to pay taxes on them. But again, it's last in, first out, like I talked about in the first video. IRA annuities are very much frowned upon by consumer advocates, and many people in the securities regulating industry talk negatively about doing that for very good reason, because you have mortality and expense charges tacked on to these annuities. M&E expense, we call it for short. What happens is you have the management fee of the fund, you have mortality and expense charges, and you have your trading costs. And these things can be very, very expensive to the investor. Now, what are the mortality and expense charges really for? Well, many times when I put money into a variable annuity, if I put $100,000 in, you might hear people say, well, they'll guarantee your investment in the annuity. And what they're talking about most of the time is this. And like I said, these things are very complicated, lots of different twists on this product. But let's say if my $100,000 grows to $110,000. Then there's a market downturn and it goes to being worth $90,000. And all of a sudden, I have a heart attack. I see my statement and it's worth $90,000. Well, if I happen to die from that heart attack, then what happens is many times the insurance company will guarantee some amount of money to my heirs, and hence saying that you won't lose money in this thing. In other words, they may give me or my heirs back, technically, the $100,000 that I invested. Or maybe the high water mark. Maybe it grew to $110,000. They'll give my heirs the full $110,000, even though the market value is that. That's part of what they charge the insurance premium for, is that guarantee of benefits. That's one concept of mortality and expense charges. Another one is this. With mortality and expense charges, sometimes you'll hear people say, well, if you take your money out and you take income later on, maybe you take a 5% distribution later on or something like that, we'll guarantee that whatever your account grew to, even if it drops in value, we'll guarantee the highest amount. And what they're telling you, again, in most cases, you got to really read the fine print on this because they're so complicated, or run it by a fee-only advisor when you do look at these types of things. What happens is, what they're saying is you have to annuitize it in order to get the high dollar amount or the high water amount. In other words, you have to hand over that contract, hand over that money to the insurance company, and then they will pay you based on this level. Well, of course, what are you doing when you hand it over to an insurance company? You're handing over control of the assets. And a lot of people don't like the idea of handing over control of their assets to an insurance company and just say, here it's yours, now pay me an income. Because of course what happens is those assets are no longer theirs, and their heirs can end up with a big goose egg at the end of everything. Now you can have 10-pay contracts where they'll pay you for at least 10 years. Even if you die in 2 years, they'll continue to pay for another 8 years. But every time you do something like that, you are reducing your payout, you're reducing the amount of benefit that you get from the contract, which kind of negates the idea of the annuity in the first place. Very complex product. Sometimes they can have a use. I'm not going to say that they never have a use, but you better be very, very careful. They are one of the most oversold products out there in the investing markets, in my humble opinion. And I'll tell you what, if you got more questions on these topics, email me, paul@paulwinkler.net. I'm going to be covering this and other topics in the future, and I love your questions. We'll catch you next time.